Well, hello everybody, and let's start. Time for us to start. Just one more time, voice is okay and audience is okay. Good to see you, everybody over here. Let me start with the file sharing. Okay, so the point is when I'm on the file over here, I'm sure you can see the file. So when I'm on the file, I will not be able to see your questions on the room. So what we're going to do is we are going to finish off the presentation. Let me go through everything. And once we are done with it, then we'll take up questions. We already have the mic. So if you have any questions, please do keep it there and we'll take it after. We have a lot of time. We'll take up the questions. Let me see if I can just make it a little bigger. Can I make it a little bigger here? Okay. All right. So we're going ahead. I'm assuming everything is fine. You can hear me okay. And you can see the file, right? All right. So this is one thing which I've always wanted to go over. Now, just a little bit of background, if I can give you. I've been trading the financial markets. Very specifically, I've been more of a currency trader. We trade different markets also, but primarily currencies for about 20 years now. And to be very honest, in the first 2-3 years, when I started with my trading, like everybody else, I really did not make it. I lost a lot of money. And but persisted onto it, knew that there is a way to do it. If somebody's making money, of course, there has to be a way. Went through the grind and decidedly came out much better. But based on that experience today, I know exactly what new traders are doing. When a new trader comes into the market, what are the mistakes that the new trader makes? And this is something which I've always wanted to give back for somebody who's coming new into trading. This is something that we should be giving back. So which is why I decided on this topic. All right, so let's go ahead. So trading the financial markets, as you can see, the statistics say that almost 80 to 90% of retail traders lose money. Now, when I'm talking about retail traders, I'm talking about individual traders like you and me. We are not talking about institutes. We are not talking about banks, about funds. Individual traders, retail traders who want to make a living from the market, who come here to learn something. The statistics are that 80 to 90% of the people lose money. Now, these are some excerpts from a trading article published in the Wall Street Journal. So the research shows that more than 80% of day traders lost money. Day traders very specifically tend to lose more money, but you could be any kind of a trader as a retail trader. The chances of success, to be very honest, today are very low, and there are reasons for it. Right? Now, most retail traders lose money due to the significant risks involved. There are a lot of risks involved in trading, and everybody knows that. There is a certain number of traders who do make a living from the market. And I can tell you that I know traders. I do. I know traders. We conduct courses. We've got students who are making a living from the market. It's not easy, but this is eventually what we want, right? We want to make a living from the market. We don't want to trade just for the heck of trading. We want to make a consistent income. And the key word over here is consistent. I don't want you to make money one month and then lose the entire amount the next month. That's not trading, that's gambling. So there is a certain amount of traders, a very small percentage, no doubt, who do make a living from the market. But this is important. This demands an in-depth understanding of how the markets work and the various factors that make up the trading process. And this is exactly what we are going to go over. The factors that make up the trading process, it's not what you think it is. There's a lot more to trading, right? So if there is a small percentage, like for example, 10 to 20% of the retail traders who are successful, obviously there is a way. If somebody is making money, there is a way. And this is what I used to do earlier and say that, okay, if somebody is making money, then there is a way. Let's start with the basic concept of trading, right? Obviously, now you could be trading any market, any market. When you want to buy let's say a currency, there has to be someone willing to sell to you at that particular time. Similarly, if you want to sell a commodity or a stock, there must be somebody on the other side who would buy it from you. Effectively, what you're doing is you are trading other traders. And so, in short, trading is nothing but the effect of the supply and demand of any financial instruments. Right? So it's supply and demand. If I want to sell and there is demand for it, I will probably get a buyer for it. So this supply and demand. But this, when new traders come into the market, there's a basic concept that they just forget. And they are instead driven towards complicated trading techniques. And what they want is just trading techniques. Multiple indicators, algorithms, the works, they try to make it complicated. But it's important to understand the very basic concept of trading. And you'll understand why I'm saying this once we get into the presentation. Right? So the simple fact is that in trading, obviously, if someone makes money, there has to be somebody on the other side who's losing money. The same concept. If I'm buying something, somebody's selling it to me. So if I'm right, the other person is losing. If I'm wrong, the other person is winning. The fact is that professional traders, people who have been in this long time, people who have got a lot of money, people who have got a lot of resources, they are the ones who tend to profit from the losses of the novice traders, the new traders who come into the market, because the professional traders know exactly where the novice traders will enter a trade. But this is important, and this is what we'll be going over. So what they do is they tend to drive price to create trap moves and stopping out the novice traders. Right? So obviously, I mean, if I enter a trade and I'm taking a buy and I keep a stop loss, if my stop loss is hit, I lose money. The other person who's on the other side of the trade makes money. It's usually the professional, and they know exactly when a retail trader is going to enter the market, what a retail trader is thinking of. Because that's what most people tend to do. Now, when I say that they create these trap moves, we are not talking about market manipulation now, especially large markets like the Forex market. It's too large to really be manipulated by a certain, even if it's an institute or a bank. But the fact is that the professionals have got enough volumes to move price. So they can come in with a lot of money, and that tends to move price. And this holds true of every market. Whether you're trading currencies, whether you're trading commodities, equities, futures, every market follows this principle, which I call as the law of the charts. Right? So speaking about the volumes, let's take the Forex market, for example, just as an example. Right? Like I said, it works in every market. But if you take the Forex concept, trading, everybody knows that currency trading Forex market is the largest traded market in the world. It's got a daily volume of approximately $6 trillion a day. But most traders are not aware of another fact, that almost 60 to 70% of this trading is conducted by banks or institutes. And it's not news, these are statistics. Let me show you some statistics here. This is the survey which is done every 1 year or 2 years, the Forex turnover. There's this company called Euromoney, FX survey. This was in 2017-18. You can see there's a list of 10 banks, institutes over here. Let me read it out for you. JP Morgan, UBS, XTX Markets, Bank of America, Citibank, HSBC, Goldman Sachs, Deutsche Bank, Standard Chartered, State Street. And the market share, I've made a note at the end in red, it's approximately 65%. These 10 banks are controlling about 65% of the entire volume of the Forex market. This is the latest data of 2019, which was done. Similarly, you see a group of 10 banks, maybe some would be up, some would be down, but again, the total is about 65%. So if these people are trading most of the market, right? So these group of banks, institutes contribute about 65% of the total volume. And putting it in simple terms, what I can say is that even if it's a single bank out of them, let's say this bank places a buy order of, let's say, 10 billion. I mean, they do that. They do this kind of trading. This will obviously create a strong demand in the market. and which will drive price to the upside, because it generally tends to have a cumulative effect, right? If this guy is buying, everybody says that, okay, he knows something that I don't know. And if he's buying 10 billion, he has a reason for it. So even I want to buy. And it keeps on building up. So this is where the volumes are created. What happens in a sense for a retail trader? The opposite side of your Forex trade, very specifically I'm talking over here, would mostly be a bank or an institute. Now these banks, institutes, they've got deep pockets, they've got the best resources at their command. So knowing who is on the other side of a trade is very important, and especially in Forex because you're likely trading against a bank. So first of all, you're coming in with a disadvantage as a retail trader. You're trading what? $10,000, $20,000, $50,000. These institutes, bank trades billions of dollars every day, literally every day. So one, you're at a disadvantage. And secondly, if you don't follow the methods correctly, I would say that you really stand no chance. And most traders are not aware of this. So what are the facts that one should really look at from a retail trader's point of view? Right? Again, I'm repeating this slide that the professional traders profit from the losses of the amateur traders, and they know exactly when the amateur trader will enter a trade. They tend to drive price, as I said, to create a trap. So now the trading decision of these professionals are taken to take out the stops of the retail traders. And this relates to the supply and demand which is created for them. Now, this is a very important statement, and I want you to understand this. They would buy and sell. One of the main reasons, of course, see, a bank is buying and selling. If a bank has got, let's say, a 10 billion of order, there could be a reason for it. The bank could be changing it for a client. The bank could be speculating on a certain level, anything. But one of the main reasons is to take out the stops of the retail traders, because that's where they will make their money. And this is exactly what we're going to go over. And this relates directly to the supply and demand which is created by them. Now, this is important. What you need to understand for every market, that the supply and demand is actually created by the professionals. Any professional, any trader who's got enough of firepower is what I call it. Let's have a look at this chart over here. So what I've done is I've plotted two bands. The one on top is a supply zone. The one on the bottom is a demand zone. I suppose you can see my cursor here, right? So this is, if you can see, I have labeled it as anticipatory sell orders, anticipatory buy orders. Now, if I'm looking at this anticipatory buy order, let's say the price starts moving up from here. This is your uptrend. I'm looking at this particular uptrend. Now, even before price stops at the uptrend, this anticipatory buy order has already been placed by the institutes. Now, the reason could be anything. Let me just tell you, the reason could be anything, right? Maybe that they place a buy order. Maybe it's for a client who wants to buy over here. Maybe they think that it's a good number. It's a round number. They do that. Maybe the trader says, okay, my birthday is on this date, so I like this number. I mean, it could be anything. Or maybe they know that maybe another institute has got a large buy order over there. So this buy order, when price is somewhere over here, it's already there in place. Now look at the logic of it, right? If this buy order is there in place, when price starts going down, to complete their buy orders, to fulfill their buy orders, what do they need in the market? They need sellers in their market, right? This is what we said, that every trade has an opposite side to it. So only if there are sellers in the market who will buy it from them, only then their buy orders are going to get filled. So what they do is they create this illusion, I would call it sometimes, of selling. So they will start driving price down. Now see what happens here. The banks, the institutes, they make money two ways. One, price is somewhere on the top over here. So from here, this bank starts selling. This institute starts selling. So he's making money on the sells. And once he starts selling, the retail traders, and this is how retail traders are taught, They see the price going down and say, okay, it's going down, let me also sell. And I'm talking about Forex market where you can short, right? Again, this goes for every market, whether you're trading futures, whether you're trading options, it's just the same thing. So this retail trader sees the price is going down, and this is what we call as fear and greed. So this greed that price is going without me, I need to get into the trade. So I would also sell. And this is exactly what they want. They add fuel to the fire. More and more sellers come into it. And before their buy order, they will accelerate their selling to create more sellers. And at this stage, when there are a maximum number of sellers who are coming into the market, people who are late into the market, people who think that price is going without me, they will sell. Where will they sell? Right into that stack of buy orders. And these banks have already got, say, 5 billion, 10 billion of bank orders. So you have sell orders, and they come into the stack of buy orders. What's going to happen? More buyers than sellers. Creates a demand and price starts going up. Now, this is how the market actually works. And like I said, for every market, because if you look at price movement, it's nothing but the effect of supply and demand. If it goes up, there is demand. There are more buyers. If it goes down, there is supply in the market. There are more sellers. Now, who creates these supply and demand zones? It's any person who has got enough money to do it. And once again, we are not talking about manipulating the markets. We are talking about using your money power to drive price to the levels, which is an everyday affair. All right. Now let's take the retail trade on. This is how the professionals, and this is what the professionals charts look like. Believe me, in my years of experience of trading and training, we conduct a lot of courses. I conduct courses globally, worldwide. I've also done some trainings with banks in London, very specifically with the Bank of America. And I've been on the other side, and I know exactly what it is when the banks tend to drive price. And this is what the charts actually look like. Do you think they have complicated indicators? Not really. In today's age and time, yes, there will be some algorithms. Today, computer-driven algorithms are there. But the charts are very straightforward. There is not too much of indicators. They might be having just one or two. They will concentrate on price, on where they see their supply and demand level. On the other hand, what does a retail trader do? The same chart. Now I've plotted indicators over here. And this is what a retail trader does. And it's not really a retail trader's fault. Let's talk about one, Mr. X, who's a retail trader. Right? Mr. X comes into this market. Now, if you do a Google search today on trading systems, trading techniques, you'll probably come across millions of them, literally. Most of them, 90% of them talk about indicators. And so the new trader who comes into the market really thinks that this is the way to go. It's not really the new trader's fault. I always say that it's not the trader's fault. It's the information which is available out there which is not correct. But unfortunately, this is the case because this is where the banks, the brokers, they want it like this. So every trader who comes into it uses indicators. Now, there are two primary indicators, and I want to go through this. I want you to understand this. The first is a moving average crossover. So I've plotted two moving averages over here. The simple fact is that when price crosses over at a moving average, you're supposed to sell or buy as the case may be. The second is in the lower window, you see this oscillator. Right now, this is just a stochastic indicator. The technical analysis books, courses, tell you one simple thing that if your indicator is overbought, sell. If it is oversold, buy. Right? Let's have a decent look at this. Now, if you look at this moving average crossover, you see the circles. I've put this circle over here. Where does this moving average cross over? And the moving averages cross here. Relating down to price, this is the place, this circle is the place where a retail trader would get into a sell trade. Where did the price start from? The price started from this supply zone. So first of all, your retail trader, he's missing this main part of the move. That's the first loss. The second, when he gets into a trade, Mr. X gets into a trade, it's probably time for price to turn around. All right? Now over here, let's take this uptrend, which is a classical example. So you had price started from this demand zone right over here, started going up. It started from here. Your moving averages crossed here. Relate that to where price is, it crossed here. So retail trader enters over here. What happens after that? Price starts going down. And isn't this exactly what you've seen? I'm sure a lot of you have seen this. At the minute you enter the trade, price suddenly turns around. But look at the logic of it. Let's look at the logic of this. Right, price starts going up from here. A retail trader is taught that wait for a confirmation, let the trend be established. Fair enough, good point. Wait for the moving average crossover. And he waits for the crossover. Okay, the averages have crossed over, now I have to buy. Now price is still going up. Now when he comes in to buy, somebody has to sell it to him. Who's going to sell it to him? And why would somebody want to sell a product which is going more and more expensive, which is going up in value? There are only two reasons why somebody would sell. Either that person is a fool who does not really understand, or the second thing is that the professional trader who has already started the move from here, who has booked enough of profit, now he wants to offload. He's the one who's selling. Obviously, retail traders come in with small amounts. When they buy, the institutes sell to them. How much do the institutes sell? Millions, billions of dollars. When they trade so much, obviously more sell orders than buy orders. What happens? Price goes down. And the retail trader is stuck over there and he doesn't know what's hit him. And he says, what the hell happened? Till the time I was out of the trade, price was going fine. But now when I enter the trade, price suddenly turned around. But this is exactly what happens. This is the law of the charts. Take a look at the second one. Take a look at this downtrend right over here. When did the moving average crossover happen? This moving average crossover happened when price was already on its way up. The downtrend has finished. The buy trades are in place and the retail trader gets in over here and he's left holding the bag. He doesn't know what's hit him. Indicators are lagging. All indicators are lagging. They will never give you the correct picture. Yes, indicators can be used properly. There is a way to use indicators. Unfortunately, most traders, again, because they've been taught like this, they tend to use the indicators in the conventional way, absolute conventional way. And when we are talking about a conventional way, let's look at this oscillator, this stochastic. What conventionally, what the books tell you or the courses tell you, when this goes above 80, that means it's overbought. Price is overbought, sell. The retail trader, if he sells over here, what happens? Price goes up. Comes back again, he sells again over here, price still goes up. He sells again over here, price still goes up. And he doesn't realize, he says, but I was taught like this. Why is it going wrong? But the interpretation is wrong. Unfortunately, most people don't go into the depth of it. It's been described, but people don't go into the depth. And they just want the face value. The simple fact is on any oscillator, if an oscillator is overbought as we push above 80, it actually means that your bullish momentum is strong. And you shouldn't be selling. You should be joining that bullish momentum. If you're selling, it's like you're standing in front of an incoming train. But this is what happens. So retail traders trade like this. And this is the main reason why they lose money. One of the main reasons. And like I said, it's not really a retail trader's fault. Unless somebody tells him, unless somebody tells Mr. X that, okay, what you're doing is wrong. And this is how you're supposed to use the indicators. And these are the factors you need to concentrate on. But there are very few people who do that. And which I've always said, when you take up a technical course, it may work for you, it may not work for you. What you need to understand is you have to have faith in your system and do the correct things. Let's go a little ahead, right? So the basic concept of trading going in this. So the new trader, when he comes in, he's only interested in the technique, the trading system. He thinks that if I have a trading technique, I'm going to make money. He might want a trading signal. So all they want is, which indicator should I use? How many indicators should I use? Should I tweak that indicator? Should I make it better? And they tend to get carried away with different indicators. There are lots of indicators. I mean, if you open up a charting platform, your broker gives you hundreds of indicators for free, don't they? Literally for free. And then in some of the cases, these people are looking for trading signals. There's someone telling them when to buy and sell. That also doesn't work. The seasoned and the professional trader, through experience, and I always say it's through experience, understand that there are other factors which are far more important than just having one technical system. Right? The other factors that we are talking about is something which I have labeled as the 3 M's. The 3 M's are money, mind, and method. So the technique, the method is part of this. But the money, it's your risk management policies, your mind factor, which is your emotions, to be very honest, which is just, I call it simply patience and discipline. The method is your trading technique. Trading technique is important. There's no doubt about it. I'm not trying to take away the importance of the trading technique. Unfortunately, what happens as traders, as technical analysts, we start from the charts, and then most traders do not go beyond the charts. They're stuck on the system. They have no concept of the money factor and the mind factor. Now, if you go a little deeper into this, if I distribute these 3 M's on a scale of 1:10, your money, which is your money management, takes up 5 parts out of 10. Your mind factor will take up 3 parts out of 10. And the method, whatever is the technique you're following or techniques that you're following, will take up only 2 parts out of 10. So you see, your method is the least important part of the trading. But the amateur traders, the new traders, ignore the concepts of money and mind. Like I said, they start from the charts and they stick to the charts. And they concentrate only on the method. And this is one of the main reasons why they tend to lose money. And further, within the methods, they tend to use indicators only, not leading factors, lagging factors, which I would say out of the 10 parts that we've got over here, a new trader would follow only 0.5 parts out of 10. And is it surprising that the novice trader fails? It's not surprising. That's because this trader, it does not have the correct tools. There is no way that this trader can really be successful. Right? Let's have a look at these 3 M's in a little more detail. We're going to start with the money, which is the most important. Now, as traders, we are obviously here to make money from the markets. But what should be your priority? What is the priority of a trader? The priority of a trader is your capital. Conserve your capital. I always say that when I'm trading, I'm a trader second. I'm a money manager first. The trader's capital is the bloodline. Obviously, you don't have money, you cannot trade. Preserving your capital is very important. Now, losing trades. Now, when we talk about conserving capital, people say that they are losing trades. Of course, there are losing trades. In fact, you will have losing trades. This market is too huge. Professionals, do you know, have got a success ratio, as I call it, of roughly about 60 to 70%, which means out of every 10 trades that a professional trader takes, an experienced trader, he would probably win 6 or 7 trades out of 10. He or she will have 3 to 4 losing trades. It's just part and parcel of trading. But then this is where your money management comes in. Because if you keep your losses small and you keep your profits larger, obviously it grows your account. It's just simple mathematics. Let's look at mathematics based on one simple concept. Again, traders know this. A lot of traders are aware of this fact, but they just don't think about it. If you're having a loss, which you will, definitely, I have my share of losses, everybody does. The loss is not only a loss of capital, you're not only losing money, it puts you 2 steps behind in your quest to profitability. That's because the gain, the percentage gain that you need to recover from loss increases geometrically with every loss. In fact, I would say it increases exponentially with every loss. And this is a simple mathematics table that if I lose 15% of my capital, I will need 17.6% to come back to break even. And let me explain this concept to you in very simple terms. Let's take the 50%, right? That if I have lost 50% of my account, let's say I've got a $10,000 account and I have my series of losses and I've lost 5,000. Now to get back to break even, I need to make 5,000 on this balance capital of 5,000. That means on my balance, I need to make 100% to get back to break even. And after that, my profit starts. So this, if nothing else, it drives home the simple fact that your losses have to be small. You must control your loss. You will have losses. There are no two ways about it. But if you keep them small, you will recover from your losses and you will make profits. This is a very important concept which every trader should follow. The other thing is there are two golden rules of risk management, what we teach. Now at Forex here, we have two basic rules of risk management. If a trader follows these two golden rules, this will automatically put the trader in the top 100%, top 10% of the winners. It's that simple. Now, in this presentation, I cannot go through that because it'll take a lot of time to explain the two rules and it needs to go into detail with mathematics. But let me tell you what we follow is the two golden rules of risk management. Let's put it this way. If I have a trade, or let me come back to this after we cover the mind factor, which is important, right? Then comes the mind factor. Now, mind factor, psychology of trading is important. Emotions take place. One, people are not ready to accept losses, which you should. It's not your conventional world where if you work hard, you will get rewarded. In trading, even if you work hard, you will still take losses. It takes a little bit of time to get used to that. Revenge trading, a lot of people get into revenge trading. They lose money. The next trade, they want to recover some part of the loss, so they'll try to overexpose their account. It happens to everybody. It's happened to me. It happens to you. It's just human nature. There's nothing else. Controlling your fear and greed, right? Just as a simple example, you are in a good trade, but you're greedy at this time that I want to take my money out. Your trade plan is telling you that trade can go further and you have a further target, but you say, no, let me take my profit today. I don't know what's going to happen. And you take your profit. You've cut your profit and you see price going up and up and up towards your target. So what you've done, you've cut your profit. On the other hand, traders tend to do this, and I still see that. You are in a trade. Let's say you're in a buy trade. You have a stop loss down. Price starts coming towards your stop loss and you refuse to accept it. Okay, something wrong. Maybe it'll turn, I'm sure. So you move your stop loss a little further down. Price still keeps coming down. And you move it a little further down. And you give yourself excuses. Oh, there's a good support zone down over here. There's a Fibonacci level over here. And I'm sure it'll stop now. And price doesn't stop, still keeps coming down. You keep moving your stop down. Price now starts chasing your stop. Haven't you had this experience? What you're doing is you're letting your losses run and you're cutting your profits. Now, this is the psychology. The simple fact is your trade plan has to tell you that I've kept a stop loss. If price goes towards my stop, get out of the trade. Take that loss, get out of the trade. Take that small loss. You will recover it in the next trade. It's not easy. Now, this is where your discipline and patience comes in. So first, patience to wait for your setup, that I have this setup and I'm not going to do anything till this setup conditions are fulfilled. Sometimes I am more of a swing trader. I probably take 1 or 2 trades a week, maybe 1 trade a week, sometimes 3 trades a month. It's very difficult to just sit back and not do anything. It is difficult, but that's where your patience comes in. And then the discipline is once your setup conditions are fulfilled, you follow your trade plan. Which brings me back, correlated to your risk management, is if I have a good trade and I see my setup conditions are filled, I see a good setup. But if my 2 rules of risk management do not fit into the trade, I will not take the trade. Now that's the discipline. I will not say that, okay, it doesn't matter. I still make money out of this. Let me take it. No, my rules say that if this doesn't happen, you don't take the trade. Again, it's not easy. But this, I say it comes from experience. And let me tell you something which I always tell my students. I don't think that traders are really good traders or born good traders. Good traders become good traders by experience. This psychology of trading, this discipline and patience is a skill that has to be developed. And this comes from experience. The more you trade with real money, the more you take your losses, the more you try to overcome those emotions, the better you get at your trading. And this is nothing but experience. Right? I haven't seen any trader who just comes into the market, says, I'm an excellent trader, and starts making money from the first week. It doesn't happen. Every trader that I know of, successful trader, has gone through the grind. I call it the school of hard knocks. Everybody has to go through it. Unfortunately, most people who come to the trading, another mind factor is that they think of it as a get rich overnight scheme. Right? That I open an account today and within 1 month I'm going to double my account and I'm going to buy a Ferrari at the end of the year. That's what everybody wants, but it doesn't happen like this. Trading requires a lot of hard work, requires a lot of effort, a lot of persistence. And it's only those people who stick there, they do make it. And if you do make it, it's a skill of a lifetime. Right? Let's get into the method part of it now. Your trading system, whatever it is. Now, see, what I'm discussing over here is what I follow. But your trading system, let me be very honest, could be anything. Just see to it that it's effective and it's simple. Don't complicate things too much. It has to be effective, obviously, and you can backtest to find out if it's effective. Now, in this, your trading system, as we said, is the least important part of the process. And we'll go over this a little more in detail. Divergence is a primary trading technique that I follow. And this is based, why do I follow it? Because like I said, from my experience of training with banks, I have seen how banks drive price. And when banks drive price to the trap levels, as we call it, it creates a divergence. And this is one of the most effective techniques that I have ever come across. And of course, I have taken it to the very next level. Everybody knows what a divergence is. I mean, if you do a Google search today, you'll know what a divergence is. I'm sure a lot of you must be trading the divergence. But we have taken it to the next level because there are different types of divergences. Like, do you know that there are 3 types of divergence? There is a class A divergence, there is a class B divergence, there is a class C divergence. We will trade only the class A divergence. And how do we differentiate that? And then we use a lot of Fibonacci ratios. I'm considered something to be an expert on Fibonacci's. It's a leading factor. It's not an indicator. It gives you good levels of support resistance and different Fibonacci's and advanced Fibonacci ratios. Let me go over this divergence a little bit, right? Now, this is one image which captures the divergence fantastically. To be honest, it's not mine. I picked it up from the internet, but it's very good. So you see this over here. Generally, this is what a conventional trader, a new trader would call as a level of support. So you have price finding support down over here. It goes up and it comes back again. And this is where a technical analyst, a new trader, an amateur trader will tend to buy because that's what he's been taught. And if he or she buys, where would they keep their stop loss? Below this one. That's what technical analysis is for. If you know it and you do it, obviously the institutes know it. And what do? They have the capacity to move price, right? They will drive price right down over here to take out all these stops. And this is a nice depiction of all the fish getting caught in the net. And they look for these levels. Did you know that banks have got softwares which help them identify where there are a lot of stop loss levels or where there are a lot of orders, and they will target those. So they don't come after an individual trader like me, but if they see a level where there are a lot of orders, and this is, don't you think, as a technical analyst, a lot of technical analysts would see this and say, okay, it's going to go up from here, and let me keep my stop down over here. And what happens? You get stopped out, and then price goes in the direction that you wanted. Now this creates divergence. Now I don't have my annotation tools here, but this support on the first level and this lower low, which is taking out the stops, this is divergence. So obviously these trap levels create divergence. So we wait for the divergence to happen, and then we get into a trade. In this way, what we're doing is we are trading with the professionals, not against them. Let me put on some charts over here. So as we see, there was a support level. You see the green band over here. And when price bounces off that support, a lot of traders will tend to go long. They will probably plot trend lines. They'll wait for a break of a trend line. The banks know this. They will drive price down. And you can see it on the indicator. It shows the divergence, bullish divergence, and then price goes up. I have put down one live trade over here. This is one trade, and generally when we have our trading rooms with our students, we take trades and we call out the trades. I try to capture chart images of the trades so it becomes a good example. So as you can see, there is no indicator over here, but price made this lower low, and this was a beautiful divergence. You can see the order over here, right? There was a buy stop order. So we placed an order above price that if price goes up, we placed a target. This target is calculated using Fibonacci ratios. For every trade you get into, you must have your entry, your stop, and your target predefined. And that's how you will manage your trade. Because if you don't know where it's going, how are you going to manage your trade? So we have our targets fixed. With Fibonacci's calculated target 1, target 2. How do we manage the trade? A lot of things. And look what happened on this one. You can see the divergence very clearly right over here. And look where it went, stopped exactly at the target. Bang on. And this was a Fibonacci level in confluence with some other levels, but this is what it is. Now, a couple of charts on the currencies. This is a bearish divergence, right? This is, I think this is on the 1 hour. Again, there was a level of resistance where a lot of traders would have got sell. Price goes up, takes out the stop, and comes down. The best part about divergence, or the techniques that we follow, they will work across any instrument, any time frame. That's the advantage. So you can decide what type of a trader you want to be. Do you want to trade intraday? Absolutely fine. Do you want to trade long term? Absolutely fine. With this pattern, you will get setups. This is a crude oil. This is a Brent crude on a 15-minute time frame. A divergence, look where it went up. We had a target 1, we had target 2. It went up right there. The divergence is seen quite clearly. So the crude, you can trade commodities. This is the ASX, the Australian Stock Index. On a longer term, this was a 4-hour chart, I remember. Bullish divergence, look where price went up. What I just want you to see is the effect of divergence, that price goes up. And what happens after the divergence is that it goes up with a lot of momentum, because now all the stops have been taken out and the institutes are free to drive price. They've made their money. So these trades work out very well. Then I have a chart on equities. There's some of our students who trade the equities. This is a chart of, as you can see, WFC, which is the Wells Fargo. It's an equity chart. It's a long-term chart. This was a divergence which was identified. You can see when price was down here. There are 2 targets we've plotted. Look at this. There are 2 targets. It's still going on the trade. And this is a chart maybe of yesterday, I think. Just yesterday. Look where price has gone, almost to the first target. And there's a possibility it might even go to the second target. So this is what we are looking at. At Forex, what we are doing is we look for these patterns which will align us to the professionals. So we wait for the professionals to create these traps and then enter the trade along with them. Does this work all the time? Of course not. Nothing works 100% of the time. But for every trade, we have an absolute ironclad trading plan, which defines the conditions of the setup. How do we identify the setup? Which defines the trading parameters. Where is my entry going to be? What's my stop going to be? What are the target levels? It defines rules of risk management. Does it follow the two golden rules? And it defines the steps of trade management. That if price goes in my favor, this is where I would tend to take some profits and let it ride. These are the levels where I would probably try to move my stop. If it goes against me, this is where I would probably get out of the trade, try to minimize the loss. All of these factors are written before you enter the trade. This is the importance of a plan. So these factors give us high probability trades. I'm not saying they work 100%. We have a share of losing trades, but the possibility of the trades are very high. And this is exactly what we want as traders, right? So Fibonacci Forex, that's my website, that's my company. Fib Forex was started with the intention of providing genuine and practical technical analysis for the financial markets. And it's always been my aim to give practical information on the procedures that work. When I teach something, when I tell you, it's because I have traded it and I am trading it and I'm finding it successful. There's only a reason why I'm telling it to you. We actually put our money where our mouth is, literally. This is based on our own experience of trading for more than 20 years because we know exactly what are the common mistakes that most traders tend to make. And I've showed you, I've gone over this. I'm sure a lot of you will relate to these facts. So if you're looking for practical trading techniques which are realistic and work on the principles of actual price movements, I would welcome you to come to my site, talk to me, send me an email. If you have any questions, let me know. This is my website. We conduct a lot of webinars, workshops, personal mentorship programs. You can see this on my upcoming, on all the programs that we have. This is my email address. Shoot me an email anytime you want. You don't need to be part of our group, as we call it. If you have any problems or questions about your trading, you want to talk about something, feel free to give me a call. Right? I do hope this was good enough and you learned some important or came across some important information. So let me get back to the room. Let me see if I can. Where are we? Okay, I'm sorry. I think. All right. Okay, so what I'm going to do is I am going to, instead of questions, I'm going to unmute everybody. You can ask me the question and it's better this way, one at a time, if at all, but let me just. Okay, please let me know if anybody has any questions. You can talk, let me know. Or if you want to put it up on the chat, I'm okay with it. Either way. I see some raised hands over here, so I don't know, I'm not getting any voices. If there are any questions, please do let me know. If you want to ask me anything, if you want to talk about anything. Or like I said, you have my email address from the presentation, which is there. You can shoot me an email, let me know. Anytime, I'm always available for answering all your questions. I think everybody's mics are on, so if you want to speak, please go ahead. And if you have any questions, do let me know.
Hello, Mr. Sunil. I just want to thank you for this valuable information.
Yeah, that's good. You're more than welcome. I'm glad you liked it. And anytime if you have any question about anything, feel free to send me an email. I'll always respond. I always respond to all my emails.
Can you please give this presentation after the your speech?
Oh, I can send it. I'm not sure if from here, how do you send it? What you can do is send me your email address. I'll send this to you. Not a problem. I'll email it to you. Or I'll find out from these organizers if there is any way that all the attendees can.
Yes, Mr. Sunil, you can send it to
Yes.
us and we can make it mass to all our viewer and the audience. And also you have a booth option.
Yeah.
They can meet you directly there, right?
Right, absolutely.
Yeah.
So yes,
and the Zoom too. Yes.
Yes, thank you, sir. Thank you so much. I will send it across. Yeah, and you will get a copy of all the attendees will get a copy. This is what I was going to come to. So the expo is still going on. We have a booth. The FIP Forex 123 is a booth in the room in zone 2. Please feel free to come over there. Talk to me about whatever you want. We can have one-on-one conversation. There's a presentation over there. There's a small video which we have over there covering these important points. So feel free to come over. Okay, so that's good. Well, if there are no other questions, if there are anything, of course, let me know. I'm right here. We have time. Nobody's going anywhere. Okay, so we've completed the presentation and looks like there are no questions. Like I said, you will get a copy of this presentation to all the attendees that we send out. Please feel free to visit my booth and at zone 2. We can talk personally about whatever questions you have. The booth is going to remain till the end of the day today. And well, thank you, everybody. Thank you very much for being over here. I do hope that you derive some value from here. And I'm going to see you later in the booth. So I'm here for some time in case anybody has anything. And if you have any questions, of course, let me know. All right, folks, so it looks like there are no questions. And so I'm going to leave the conference room and I'm going to be at my booth. If you have any questions, anything you want to talk about, feel free to visit my booth and let me know. Of course, send me an email if you have any questions. All right, well, thank you again for being over here, and I wish you good trading, everybody.